This is Paul Donovan from UBS's Global Economics Department. The focus is mainly on the United States today, though not really on the data. We do have the release of consumer price inflation, and in normal circumstances this would be an event of some importance. These are not, however, normal circumstances. Even the most ardent of inflationists has capitulated to the inevitability of disinflation in the near term. Only the lunatic fringe that regard adjustments in the composition of the CPI as a giant conspiracy to defraud the consumer have any possible grounds for concern about pricing. Today's data is therefore hardly a major issue for policymakers. We're looking for a 1% drop on the headline, which is all energy prices, of course, with a 0.1% core rise. The headline inflation drop on weaker gasoline has failed to lift the spirits of the American consumer, who hit another all-time low in terms of consumer confidence with a minus 52 reading on the ABC Comfort Index last week. If Americans are not even able to take comfort from the fact it costs less to fill up the family fleet of sports utility vehicles, you know something is wrong with the economy. We now need to get a sense of what the policy response is going to be. Conveniently, we're getting that in the form of the FOMC minutes today. Those who have speculated about quantitative easing should note that a quantitative monetary policy requires a central bank to target the quantity of money explicitly, rather than targeting the interest rate. The Fed may not be terribly effective at targeting the interest rate at the moment, given where effective Fed funds has been trading, but it is, at least notionally, in pursuit of the Fed funds rate. Further, the whole point of quantitative easing is that you are seeking to influence expectations. Quantitative easing is therefore not something to be closeted away behind closed doors. If a central bank is to pursue quantitative easing, it needs to be loud, proud, and prepared to declare its intentions to the wider world. Otherwise, it is all a futile gesture. Probably best not to call what is happening today quantitative easing, therefore. However, it is worth looking at the minutes to see the extent to which quantitative easing is a possible policy objective and what other options the Fed has been considering. The Bank of England minutes are also due today, and here there are more conventional concerns. How low will the Bank of England go, and how quickly will it get there, especially in the wake of the significant 150 basis points of easing that we had at the last meeting? We believe that the base rate goes to 2% at least, and in the current climate it is, of course, eminently possible that we go below that limit. We would also expect the Bank of England to be relatively swift to act, unlike the somewhat sloth-like performance of certain other European central banks. The UK CBI Industrial Trend Survey is also due for release today. Meanwhile, in the world of finance, the Financial Times has reported that Citigroup is in the process of liquidating the CSO hedge fund after losses of over 50%. If so, this would mark the 9th time the bank has had to close a fund in its alternative investment unit. Finally, there are a variety of central bank speakers today, from the Fed, the Bank of England, and the ECB. The potential for surprises from the Anglo-Saxon world is somewhat limited, and indeed somewhat overshadowed by the release of their respective minutes. That's all for today. Have a good day.